Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And glad to be back. Sometimes it's not so easy. Oh, do you ever just feel that way? Like you get up in the morning and there's just one challenge right after the other. Yeah, I guess we all have days like that. But glad to be alive, glad to be here, glad you're listening. I'm going to try to cover some topics I think are pretty relevant today. Primarily, why you need to be relatively careful in studying your own personality when it comes to your money, especially when it comes to investing. I cannot tell you how difficult it is to remind yourself that, yes, you're doing the right things. You're doing the right things. Okay, assuming that you are doing the right things. That just means that you have a plan. And the plan doesn't have to be complicated. I'm in the industry. I read a lot of the same stuff that you do, and I hear all these extremely elaborate plans. Well, a lot of that stuff doesn't really have anything to do with you, but it makes for good fodder and fills up lots of pages and lots of magazines, lots of websites, and sells lots of ads. Okay, so trying to figure out what is pertinent to you, what is important to you, that's a personal thing. Now, there are some things that you should definitely try to be aware of. And, like the cost of healthcare in retirement, if you're getting close to that age, it's a big cost, one of the bigger costs. You should look at the amount of income that you could reasonably generate given the amount of savings that you have. And, I keep threatening, by the way, to write that book. And the reason I don't is because there's not enough material to write a book on how to retire successfully. There really isn't. I mean, there's not that much to it in 95% of the occurrences. So 19 out of 20, all you really need to know is how much you have in savings and what are you going to get from pensions and Social Security, if any. So if you know that, literally, you can figure out what the sustainable lifestyle could be, and it takes me about 40 seconds. So it shouldn't take you much more than that, but that's because I've been doing it for a very long time, and you know what? It's just not that difficult anymore. I'll tell you what is difficult is you're probably going to have to average somewhere around 6% a year net of all fees and expenses to be able to spend 4% a year, because you've got to reinvest something for inflation. And by the way, this current inflation rate, here's what I'm going to predict. I'm going to predict that it goes down. I'm not predicting that inflation's going higher, and I really don't like predicting anything, by the way. It's, if you do it long enough and you write down what your predictions are, you'll stop. You'll just stop. But I'm going to predict that at some point in time, and I don't know how long it takes, really don't know, but at some point in time, it's probably not going to be as fast as we've seen it over the past 18 months. And lots of reasons for that. I mean, at some point in time, things settle down. Problems have a tendency to get resolved in one way, shape, or form. And I think there's a pretty good chance that inflation actually goes down a little bit, maybe back to a normal range of, say, 4% or so. That's actually kind of normal if you go back over the past 100 years or so. And I think that's it's still pretty difficult. I mean, 4% increases when you're in retirement and you've got a fixed income. That's pretty difficult. And that's why I'm saying you're probably going to have to earn somewhere around 6% because you're going to have to keep up with inflation a little bit. And that doesn't give you a ton to keep up with inflation if inflation stays at the current rate. Is it going to stay here? I don't know. Nobody does. I doubt it. I think inflation probably starts to come down at some point in time, but that time's not right now. And incidentally, I send out a newsletter. And I send one out every other week, and sometimes 2 weeks in a row. The vast majority of the time, it's every other week. If you'd like to get a copy of that, and a lot of these topics are being discussed, I actually go in and edit the newsletter to try to keep those articles I think are most pertinent to what you guys are interested in out there. And you can go to my website and sign up for it. It's free. By the way, no salesperson's going to call you. I have a really hard enough time calling back the people who want to talk to me. So, just go to bullingtoncapital.com, sign up for it. And there's some really nice articles from like Barron's and Forbes magazine, Fortune magazine, the Wall Street Journal. I have a really nice service. They go in, they suggest these are the most popular articles. I pick the articles. I get to edit text that goes along with that, and then we just send it out. So there's no cost. And again, just go to my website, bullingtoncapital.com. You can sign up for it there, and I would be glad to put you on that list. And let's see here. Just looking at the stock market, it's pretty interesting. I mean, you know what? I would have thought that the market would have been a lot. I thought it would be down a lot more than it is right now. It's down pretty good. I mean, this is not it's still down 17% from where it peaked back in January 2022 this year. But it's not down as much as it was a few weeks ago. Actually, the last couple weeks, it's been dropping again. Yesterday was a pretty good day. It was on light volume, so that's a little concerning when you get a big move up on light volume. I don't know. Should you try to pay attention to this? Probably not. The vast majority of people would be much better off if they went into their financial plan for retirement, particularly the money that you're going to be using to supplement your income. You need to get that figured out before you actually start taking the income. You don't want to be panicking, wondering if you should make a change or not when you're already retired. See, because if you make a mistake, that is incredibly difficult. When I say incredibly difficult, I mean, there's a 99% chance that any correction that you're going to make is going to end up costing you even more money. Okay, so you should think about those things before this happens. You should try to imagine, okay, the market has been down over 50% multiple times in my lifetime. And my life expectancy is about another 30 years. Okay, so do I think it's probably going to happen again? Probably. Do I worry about it? Not at all. Well, why am I not worried about it? Because I already know what I'm going to do. That's the big deal. That's a really big deal. Investing is 95% psychological, 5% what you do. Now, the 5% part, the 5% of what you actually do, okay, it's like trying to bake bread and not having yeast. Yeast is not a huge component, volume-wise, to a loaf of bread. I think it's probably less than a tablespoon. But without that yeast, you're not having bread. You're having a pancake. So, and that's exactly where the mentality of the investor comes into play. You want to be successful, 95% of it is going to be attributed to what you're doing. That other 5% is whether or not you're panicking. That 5%. So that yeast function that your mind is creating, if you've got that part, so that's what I'm saying. You got to have that as well as the strategies that you're using. And you just want to make sure that you give that a lot of thought before things get bad. Because when they start to get bad, and from time to time, it's just it's the nature of the beast. It just happens. And if you look at history, yeah, it's happened. Is it highly predictable? No, it's not highly predictable in terms of when it's going to happen. The fact that it's going to happen, that's pretty highly predictable if you look at history. But exactly when it's going to happen, how deep it's going to be, how long it's going to last, those things you can't really know. So you have to plan for that. You have to plan for the unknown. And I know a lot of people say, well, you're just speaking nonsense. You can't plan for something that you don't know about. Yes, you can. Yeah, I don't know when the market's going to go down the way it has, but I know this won't be the last time. Okay. So if I'm ready for that, if I'm mentally prepared, and if I'm not, then you need to talk to your financial advisor, or you need to keep listening to the show. But if you're not mentally prepared for big declines and you've got money in stocks, you're going to be miserable. And you're going to be miserable not only to yourself. People, I hear it all the time. They're beating themselves up. I should have done this. I should have done. Well, that's partly true, but not the way you think it is. Okay? You shouldn't be beating yourself up for not having seen something coming that millions of other people didn't see either. Okay, that's not what you want to beat yourself up for. Actually, you never want to beat yourself up. You want to get on the right track. You just have to learn more, figure out what you need, figure out how much risk you can really afford to take. How much risk can you take? And I just bought one of the, not just bought, but I've had for a few years now, a fixed indexed annuity. And people look at me like I've got three eyes sometimes. Why would you do that? Well, because there's a certain portion of my cash that I just wanted safe, and I wanted to know what it was going to be when I get ready to retire. I wanted to know what was going to be there, and not even when I get ready to retire, but when I can withdraw Social Security and make as much money as I want without a penalty, I'm taking Social Security. I'm not waiting anymore. So, and I will reinvest that money, just for the heck of it. But so this is kind of like that. When I'm full Social Security age, I know what the schedule is, what kind of income I can generate from that for the rest of my life. Okay, they put that in writing. That's a contract, and assuming the company stays around and stays healthy, and they better, because they're a big company. It's A+ rated. By AM Best. So I really think that, that gives you a lot of peace to know that I could basically live just on Social Security and the money that I would get from that. So the rest of my money, I can be a little bit more aggressive with. And I am, because I would like to see what'll happen. But if I'm not, I'll be fine. And that's basically, those are the kinds of things that you want to talk to your financial advisor about. How do you get that glide path where, okay, I'm not working anymore. I'm just going to start taking money out of my investments, and I'm going to have these other sources of income. What can I reasonably expect there? What could I reasonably inspect? Sound like Trump now. Yeah, what can I reasonably expect? I've been watching too many Trump videos. It is hilarious. I mean, you know what? That's one thing that he was definitely underpaid, because he's really funny. The gaffes that it's pretty wild. I thought Bush #2 was pretty funny. But what did he say that one time? You know what? I got to go to commercial break. Sorry about that. When we get back from these commercial messages, I'm going to enlighten you on the best Bush impersonation that I have. It's not very good. So, but anyway, this is Bill Bullington. I'll be right back.
And tell my heart to beat, but without you I'm just as dead as any man could be. I could travel sea to sea just to discover me, but if life's just me, it's another mystery. Before you, my life was so empty, and then you opened my eyes and set me free. I didn't wait for someone to tell me it's right. I know my love for you is real, 'cause I can feel it inside, and that's all I need, 'cause your love sets me free.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you like this show, you can actually listen to it again on YouTube, or you can go to my website. There's a link there, and I think it's on iHeartRadio, if I'm not mistaken. So anyway, I'm getting off and talking about a whole lot of stuff. By the way, for you stock pickers out there, I've got something you need to hang around to the last session or last 15 minutes of today's show, because there's a trend that's popping up on the scans that I run every day. I have done that for so long. I don't do a lot of individual stocks anymore. I do some. And I will tell you that this week I'm going to be making some changes for the first time in several months. Why? Because there's a trend that I'm seeing that I want to alert you to. And I like it. I mean, it's pretty awesome to be able to see this kind of stuff and then understand why it's happening. In fact, we were just talking about understanding your investment process. That's a big deal. It's not that hard. And I feel horrible for the average person out there that wants to study investing and wants to get up to speed. Kids just right out of college. I mean, you've got a long way to go. There's so much stuff. I mean, and it's not that you have to know all of it, but you got to be able to tell the difference between something that's important and something that isn't. And that's the hard part, because 9 out of 10 things you're going to read are not going to be important. And actually it's probably 19 out of 20. And being able to just kind of hone in on that 5% of the information that is important to you, that's going to be meaningful to you, that's a skill. And you'll spend a lot of time trying to develop that if that's the route that you want to go. Thankfully, it is such a difficult task that's why I have a job, because I like doing that sort of thing. In fact, I read a lot, and I'm about halfway through this 600-page book, and I didn't have access to the types of tools that I needed to execute this for a while, so I just sucked it up and subscribed to the software. And yes, it's expensive, but it's going to help. And right along the lines of what we were talking about, if you took a profile of stocks, let's say stocks that had profits, okay, that'll eliminate an awful lot of stocks. And some stocks that are going to go up a lot, they go up on rumors or, basically gut feeling instinct by hedge fund managers and individual investors out there who feel like, there's a company out there that's never mind that it's not making money now. They believe in the future that it's going to make a lot of money, so they're willing to pay up for it right now. That happens a lot. Okay? At some point in time, the problem with investing that way is you've got to predict when they're going to lose interest in that company. And then if it doesn't pan out, who knows about it first? Because I promise you, there are a bunch of really sharp hedge fund managers out there that will sell those stocks short, meaning they're going to try and push them down. And it's just really rough. That's why you got to have a plan. Plan doesn't have to be all that complicated. In fact, one of the models I really like a lot is you line up the biggest stocks in the country. They say the top 3,000. That's the Russell 3000, by the way. If you were to look at all those stocks and then look at those that have profits and then take those profits and divide it by this thing they call enterprise value. Don't worry if you don't get this stuff, by the way, and don't knock yourself out trying to replay the podcast of this. If you want to get that information, you can just call me. I talk about it all day, every day. I like doing it. I like reading about it. Anyway, so there's this measure of cash that the company is generating. Okay, it's just a measure of cash. It's an estimate of the amount of cash that they made over the past 3 months. Okay, you can take the past year if you want to look at it that way too. And that's generally what I do. But you look at the amount of cash that's being generated, and then you look at what the current market value of the stock is, and then any debt that they have. That's what it would cost you today if you were to buy every share of this stock, so that basically you have control of the company now, and you bought all their. You had to. If you did that, you'd have to pay off their debt too. So when you add the debt to the value of the entire company's stock, that's called enterprise value. Okay, that's what you would end up, that's what an acquirer, if Warren Buffett went in there, he's an acquirer. If he went, that's what he would end up paying. He'd end up paying the price that they agreed upon for all the shares of stock, and then he would assume their debt. So that whole cost there is what he's looking at. And I promise you, I know he already knows what the amount of cash that company's been generating. And if you divide that cash by the cost of buying that business, now that sounds pretty simple, doesn't it? Notice I didn't use one 3-syllable word in that sentence. And I think that's probably one of my stronger points, is trying to break this down so that I can understand it. And I'm pretty normal that way. I wasn't raised in an academic family and had very little to do with finance, so I'm with you guys. I had to come up the hard way. But bottom line is, you take this cash. Let's say it's the cash that they generated over the last year is $1 billion, because there are a lot of companies that are doing $1 billion now in cash. Okay. And then you divided that, and the value of the company's stock plus their debt was $10 billion. Okay, so the $1 billion in cash they generated happens to be 10% of $10 billion, right? That's pretty simple. But what that does is it lets me know, if you were to buy this company, paid all their debt off, and paid every full price for the share price of whatever it was at that time, and you paid $10 billion, and you generated $1 billion in cash, okay, that's a 10% return. That's pretty good. Now, I can hear all the CPAs and CFAs right now rolling their eyes and saying, "You can't make it that simple." Oh, yes, I can. And I can. It's the general concept. Yeah, there are thousands of little rules in there. And, actually, I think the general accounting. So I lost my place, but let me pick up where I left off. Generally accepted accounting principles. Okay, that it would take an incredibly long time to learn all that, by the way. And if you did learn all those generally accepted accounting principles, then you could go in and see, you know exactly what I was talking about. But for illustrative purposes only, okay, this is just to give you an idea of why one company may be worth more down the road somewhere than another company. Let's say the two companies are identical. I mean, they're competitors in an industry. One of them generated in cash, that cash flow measure that I'm not going to bother boring you with again, but one of them generated $1 billion and the other one generated $500 million. Okay, and they're both selling for $10 billion. Which one would you rather have? Would you rather pay $10 billion for a company that's only making $500 million, which is still pretty good, or would you pay $10 billion for a company that had $1 billion, right? The answer should be relatively easy. You'd be surprised at how many times people will take the other choice, the one that's got a return that's not quite as high. Why is that? Well, it's because emotion gets involved, and they may think that for whatever reason, that company is better. It's worth paying more. It's worth getting a lower return. And that happens quite often. I mean, you'd be surprised how frequently that occurs. So when I'm looking at a fund that's going to pick stocks, that's one of the criteria that I like the fund to look for. I want them to be looking at the profit margins on the companies. I want those profit margins to be high. I want them to be higher than average. Why? Because in the long run, it makes sense. In the long run, it really helps your investment policies perform. In the short run, and the short run is anything 5 years or less, by the way, it's amazing to me how long a company can go up and get overpriced and then stay overpriced. And it'll outperform the other company that's more profitable, sometimes for a very long time period. And that's what's very confusing about investing, is because when that's happening and you see or hear people talking about the stock of the day, the week, the month, the year that's done so well, and you look it up and you say, wait a minute, that thing is way ahead of where it should be. It shouldn't be selling at that high a price. It's not going to make you feel any better because you feel like you missed out. Well, you see, the problem with that, and that's one of the problems of investing on your own without a tremendous amount of knowledge, is that you're going to feel subject to that. Those feelings that you're going to get, you're going to feel like, well, I probably should have known that. Well, no, you shouldn't, because you can't know that. Nobody knows that. That's one of the reasons that you write down and have a list of rules to govern your investing processes. Those companies that get ahead of themselves, at some point in time, they go down. At some point in time, some of them go down and never come back again. So that's a problem if you've gotten too overconfident in a company and you've stopped looking at its numbers. That's one of the things that I think disciplined investing does. You can do it yourself, by the way. It's, better get ready to quit your day job. But today there are funds that are doing that for you, and I think that's such a godsend. Somebody implanted that idea. I think probably God implanted that idea in somebody's head, because I'm not sure that the humans are bright enough to come up with that on their own. I'm just kidding. But anyway, they're doing this now, and they've been doing it for a while. And it was a major trend a long time ago, and now it continues to be a major trend. If you can think of an idea to some way to invest your money, there's probably a fund out there that's doing it. I have my favorites. But if you wanted to do it yourself, yeah, you can buy some fairly expensive services that'll go in and pick those stocks for you. You write down the criteria. It'll search them out for you. And then you just build a portfolio that way if you want to. But whatever you decide to do, you just have to be comfortable with it. And the comfort comes from knowing that somebody is doing the work that needs to be done. Because you can't just, well, I guess you could. I've seen that happen a lot of times. People just throw darts, or they just look at past performance alone. That by itself, you're basically relying on your luck. And I'm pretty sure that when I drove down to the radio station this morning, I didn't see anybody driving by looking in the rearview mirror. That's what you're doing when you're looking at just past performance. You're looking in the rearview mirror and saying, "Hey, that looks pretty good." Well, yeah, until you run into something. And it's the same thing with your portfolio. If you're driving looking in the rearview mirror, sooner or later you're going to run into something. It's not going to be pleasant. So it's I don't mean to try to scare anybody unless you're absolutely doing all the wrong things. And most people aren't doing all the wrong things, but looking at past performance, that's just one of the things that you need to look at. You should probably be looking at what they're actually doing with the money. And if you don't understand what they're doing with the money, if you've got an advisor, then call them. Find out. What is this fund? How does it pick the stocks? I think I have about 8 funds I really like, and they're different, by the way. Some of them are concentrating on smaller companies who have certain characteristics. Some of them are international. That's not a lot, by the way. But some of them are just looking at the large cap. And then I've got the companies that are specialized. the funds that specialize in one or two industries. Like I have a healthcare model I like. There are 3 funds in that model that I really like a lot. I have and there are multiple ways of doing that. Now that I hear the music, I'm going to have to wait until this commercial break is over to tell you about it. This is Bill Bullington right here on 1420. Stay tuned. I'll be right back.
What you gonna wish you could undo when it's all said and done? Wish TikToks on the cloud. Are you running round in circles with no place to go? Is there a person in the mirror you don't even know? Someone still sees you.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. If you'd like to get in touch with me, just give me a call. The 330-664-0700 is my office number. Or you can go to my website, it's bullingtoncapital.com. And, I know I've been talking about a lot of stuff, and there's a lot of details, and I talk a lot. So there's, if you can't follow it, don't worry about it. I couldn't follow this. It's a long time. I mean, even when you're in the business every day, it takes a while. And I'm just grateful that I hung in there. And when you hang in there, you can actually really learn some things and it helps you out psychologically. Investing is 95% mental. I'm telling you, I'll say that for the rest of my life. I'm sure of it. 95% mental. Now, that other 5% that requires you to know something, figuring out which 5% is important, that takes a while. That takes a long time. And then when you figure it out, and when you think, oh, these are the most important things, after years of watching stocks and reading and watching mutual funds, talking to portfolio managers, other portfolio managers, you look at it, you go, oh, wow, it's really... The technical side of this is not all that complicated. Nope. But you won't even come to that realization until you've been doing it for an incredibly long time period. Unless, I've met an awful lot of people who got lucky. I mean, I talked to them and I'm like, wow, that's amazing. See, that was never in the cards for me. In fact, I'm pretty sure that the minute I decide to retire, the market's going to go, it's going to have a really bad bear market. That's my luck in life. So I was never one of the lucky people. And it's really hard, by the way. I know you've probably all met somebody during your life, if you're past the age of, I say, 20 maybe. You've all met somebody who just got really lucky and thought that it was skill. And that's really difficult from an advisor standpoint. To have to say, hey, you know what, I'm glad you made a lot of money, but, it was basically luck. And oftentimes, very difficult to say that, but anyway, and it's at some point in time, if they don't get the knowledge, they'll learn. I can't tell you how many people I've seen who had, an unbelievable amount of money. It was luck. And then when the luck went away and those stocks came back down, okay, then, they thought that they had lost their minds. And, I was so smart. I knew this so well. No, it's just actually, you really needed to have a little bit more knowledge. And if we can help you there, I would definitely be glad to. It is really tough, man. I mean, when you're looking at this stuff, so many things just don't make sense in the short run. In the long run, they tend to make sense. It tends to work pretty well. You buy companies, we were talking about a little bit earlier, that are doing well down the road. If they keep doing well, that's the part that you can't know. You have to monitor that stuff. But if they continue to do well, at some point in time, assuming that you didn't overpay for the company, it probably goes up. Now, having said that, a lot of people getting close to retirement. Why am I spending so much time on stocks today? Well, you need a little bit. Now, you can buy other products. You can invest in other products today that'll guarantee an income stream that's actually higher than that 4% rule that I keep talking about. Okay, and I think today, given the environment that it's in, if you look at what bonds are doing, bonds are dropping like a rock. I mean, and have been because interest rates have been going up. So, in fact, one of the most popular bond index funds is down 15% from where it was it looks like July of last year. So just in a little over a year, a bond fund, which is supposed to be relatively safe, okay, is down 15%. That's a lot. That is a lot. If you were buying short-term bond funds, you're still down, but probably only 2 or 3% or so. Not a lot. It's still down, though. But if you reinvested the income on those short-term bond funds, you're probably slightly positive. Big difference between down 15% and slightly positive. Wouldn't you agree? I mean, a big difference. And that's why knowing this stuff, it can take a while. It can seem kind of frustrating. And that's where, I like spending time talking with people about it. It's all I do. Actually, that, and put in the orders and do all the research and all the other things we have to do. Produce a radio show, which is I feel bad for you today. I have been, my mind's been jumping around so much. So that's what I get for getting a really good night's sleep before getting in there. I've got too much energy. But anyway, so we were talking a little bit about, having plans. The plans do not have to be complicated, by the way. If your plan is really, if you can't write your investment philosophy down on a single piece of paper, a single page with not more than 25 lines in it, I'm going to suggest you need to go back and revisit that thing because you should be able to do it. And it should be fairly clear. And if you can't do that, well, give me a call. I'll help you. And again, a lot of people think that the past performance is the only thing that matters, and it's really not. I mean, I can tell you that the best performing investments also have had the highest amount of fluctuation. The best performing investments have had the highest level of fluctuation. And unfortunately, that fluctuation, when it's going to go up or when it's going to go down, is nearly impossible to predict. So if you've got all your money in there and you're expecting your financial advisor to tell you when the exact right time is going to be, you're both going to be disappointed. Actually, the financial advisor that took that account should say, hey, you know what? Yeah, we can't agree on that. If you think you can predict worldwide events with a high degree of accuracy, well, I'm going to give my money to you. If you can show me, if you can prove to me that you can do that and why. And by the way, I'm really tough to convince because I've been around the block a few times. This is not my first rodeo. So, it's hard. But as I started out earlier in the show, when you're looking at things like sales, like profit margins, like valuation, how much are you actually paying for this company relative to what other companies that are similar are selling for? That's a lot like, finding a good price on a house in real estate. If you don't want to overpay, go find out what the other houses have sold for in that neighborhood, the ones that are similar to the one that you're looking at. Don't compare the highest value to, that it's ever sold. I remember back in I think it was 2006, somebody from California moved into my neighborhood, and they paid an unbelievable amount of money for that house. I mean, it went for more than twice what any of the other houses had gone for. And they thought they were getting a good deal. Why? Because they were comparing the houses out in California to the houses in Ohio. And so they overpaid. I mean, big time. It took them about 15 years for that house value to appraise at the same price that they'd paid for it. Now, when people do that with their stocks, they do it all the time. There are a lot of companies that will go down and stay down for quite a while. I'm going to kind of leave this for next week. I've got this is going to kind of be a series. Next week, I'll actually talk about some specific models that you can use to help you pick your stocks or to help you understand what it is your advisor's trying to do for you. And so I'll leave that there, and I'm going to talk a little bit. I get questions every week on fixed income, and it's a big deal. Now, you can buy CDs now. You can buy treasuries from broker-dealers. That whole market is huge. I mean, and half of the Series 7 exam used to be just on bonds, which are also called fixed income. It's kind of a big deal. You've got fixed indexed annuities out there. That's another animal altogether. It gets kind of shepherded in with the fixed income category. It's not traditional fixed income. Traditional fixed income is something where the maturity date is fixed. The interest rate is fixed. That's traditional fixed income. Most people understand CDs, and CDs are a form of fixed income. So are treasury bonds. You buy those directly from the federal government. Why do you buy them when their interest rates are down around 3% or so? Well, actually, at 3%, by the way, is pretty good. It's up a lot from what it was a couple of years ago. That's why those bond funds are down, by the way. Why would you want somebody's bond that's going to pay 1% when you can get 3%, right? So you're going to have to, if you've got a 1% bond out there, you're going to have to drop your price to attract a buyer to that bond. And, when I start talking about this, I feel so bad because so many people I know, if you're in your car, don't worry about this. Just remember the Bullington Capital. You can always email me or call me. I'd be glad to try to explain this in detail, a little more detail. It's actually not that hard, but when interest rates go up, bond prices go down. That's, you've probably heard that before. A lot of people don't know why. That's not the only thing that can cause interest rates to go down or bond prices to fluctuate. But right now, short-term bonds are paying almost as much as long-term bonds are. And rates are significantly higher now over the shorter-term maturities than they are in the or have been for quite a while. So it can become a piece of your overall portfolio. It's there for the safety. That's why it's there. If you're buying a short-term bond fund or you're buying short-term CDs, even I'm not a big fan of buying 30-year CDs or treasuries just because they fluctuate too much. I mean, they're flying all over the place. When you're buying fixed income, you're supposed to be buying something that's fixed, right? You want balance for your portfolio. When you add that value back to the other holdings, which are probably mostly stock, okay, that should give you a much better feeling of safety. That's what you're looking for in there. You're looking for things that have guarantees that stocks don't have. And the interest rates on those are different. Treasuries, you gain interest every day that you hold a treasury. The price that you get on the day that you sell it is going to be depending on whatever it's selling for that day. The shorter term maturities don't fluctuate a whole lot. Okay, CDs now, they buy and sell CDs just like they do treasuries. Treasuries, you don't have to pay state or local income tax on. CDs, you do. So there's a little difference there. Some CDs accumulate interest in different ways. There's a lot of stuff to this, but the point I'm trying to get across is that you've got a lot of options out there. You've got a lot of options, and some of them are much more attractive than they used to be a couple of years ago. In fact, I never touched an indexed annuity up until a couple of years ago when they, and now now that interest rates are going up, they're raising the payout rates on a lot of those products. So again, as a portion of somebody's portfolio, for the safety, and it really depends on the individual. That's one of the things that the government's been trying to impress upon people in the financial industries, services industry, that look, you need to customize the portfolios. You need to talk to your clients. You can't put everybody in the same thing and just say this one thing is the best thing to do for everybody. It just life doesn't work that way. It's really funny to see a couple sit down And when they're really different as far as their investments go, some super conservative, some kind of moderate, and then some really aggressive. I didn't realize I was going to have to be a marriage counselor when I got into this industry, but that's okay. It's just part of the job. And trying to explain, what can happen, why things can happen. Looking out, you can do whatever you'd like to do. It's your money. If you do this and then this happens, that's the biggest job an investment advisor has. Go through the what ifs. Are you okay if this happens? What if this happens? Are you going to be okay with that? How are you going to feel? And a lot of those questions, especially the how are you going to feel if this happens, those are not that easy. You'd like to have somebody to discuss those with, somebody to talk it over with. Why? Because, doing it on your own, you may miss something. You may not understand that some important feature that certain investments have. May not understand that. Why did my stocks drop the way they did? Well, because they're stocks. That's actually the real reason. Stocks are highly unpredictable in the short run. In the long run, they're a little bit more predictable. And when I come back next week on this show, I'm going to talk about some of the factors, factors is probably the best word for it. Some of the factors that stocks have had that have been successful and whose factors have contributed significantly to that success. Now that I hear the music, that means my show is definitely over. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can find me on my website, bullingtoncapital.com. Have a good week, everybody. Good luck. Good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.